Gold just dropped 8% in 72 hours. 8%. That might not sound catastrophic until you realize we're talking about the most stable store of value in human history, the asset that's supposed to protect you when everything else burns. On February 3rd, gold was sitting comfortably at $2,700 per ounce, flirting with all-time highs, making investors feel invincible. Then came the hammer. Within 3 trading sessions, we watched nearly $220 per ounce evaporate into thin air. Pension funds panicked. Retail investors who bought at the top are now staring at losses they never saw coming. And here's the kicker. This isn't just some random blip on the chart. We're seeing ETF outflows hitting levels we haven't witnessed since the Fed started its most aggressive rate hiking cycle in 4 decades. So the question burning through every investor's mind right now isn't whether gold crashed, it's whether this is the beginning of the end for the greatest bull run precious metals have seen since 2011, or if we're watching the most violent correction before an even more explosive move higher. Stick with me for the next 15 minutes because I'm about to show you data that Wall Street doesn't want you to see, historical patterns that predicted crashes with eerie accuracy, and the 3 scenarios that will determine whether your gold position makes you rich or leaves you holding a bag of regret. But before we dive deep into the charts and the chaos, if you're serious about understanding markets beyond the headlines, about seeing the patterns before they become obvious, then hit that subscribe button right now and turn on notifications, because we're breaking down the financial stories that actually matter to your wealth 3 times a week. And trust me, you don't want to miss what's coming in the gold market over the next 60 days. Let's rewind the clock for a second, because to understand where gold is going, you need to understand the absolutely insane journey it's been on. Just 2 years ago, in October 2022, gold was trading at $1,600 an ounce. Investors were depressed. The narrative was dead. Everyone said gold was finished, that crypto had replaced it, that stocks were the only game in town. Then something shifted. Quietly at first, then all at once. Central banks around the world, and I'm talking China, Russia, Turkey, India, Poland, they started buying gold like their currencies depended on it, because frankly, they did. The World Gold Council reported that central banks purchased over 1,000 tons of gold in 2023 alone. 1,000 tons. That's the 2nd highest annual purchase in recorded history. These aren't dumb money retail investors gambling on Reddit threads. These are sophisticated institutions with PhDs running economic models you and I will never see. And they were loading up. Meanwhile, inflation was ripping through Western economies like a freight train. The Consumer Price Index in the United States hit 9.1% in June 2022, the highest reading since 1981. People were watching their purchasing power dissolve in real time. A tank of gas that used to cost $40 suddenly cost $70. Grocery bills doubled. Rent became unsustainable. And what happens when currency loses value? Smart money runs to hard assets. Gold started climbing. 1,600 became 1,800. 1,800 became 2,000. By December 2023, we cracked 2,100, and the momentum was undeniable. Fast forward to late 2024 and early 2025, and gold went parabolic. We blew through 2,300, then 2,500, and by late January 2025, we were knocking on the door of $2,800 per ounce. Investors who bought at 1,600 were up nearly 75%. 75% on an asset that's supposed to be boring and stable, that stock market returns on something that's been a store of value for 5,000 years. But here's where the story takes a dark turn. And this is the part most YouTube finance channels won't tell you because it's uncomfortable and it doesn't fit the gold always goes up narrative. Every single parabolic move in history, and I mean every single one, ends in a correction. Not because the fundamentals changed, but because markets are driven by human emotion, and humans are terrible at managing greed and fear. When gold hit 2,700, the options market went absolutely bonkers. Call option volumes spiked. Retail investors were piling in. CNBC started running segments on gold. Your uncle, who hasn't invested in anything except his checking account for 30 years, suddenly wanted to know how to buy gold coins. These are textbook top signals. And right on cue, the selling started. February 3rd was the first crack. Gold dropped 3% in a single session. Analysts called it profit-taking. Nothing to worry about, they said. Then February 4th hit, and another 2% vanished. By February 5th, we were down 8% from the peak, and the financial media went from cheerleading to obituaries in 72 hours. Headlines screamed about the gold bubble bursting. But here's what none of them told you. Gold has done this exact dance before, multiple times. And what happened next is absolutely critical to understanding where we're headed. Let's talk history, because history doesn't repeat, but it absolutely rhymes. And if you ignore these patterns, you're going to get slaughtered. In 2011, gold peaked at $1,900 an ounce in September. Everyone thought it was going to $3,000, $5,000, $10,000. Books were written about the coming gold standard. Then reality struck. Gold proceeded to fall for the next 4 years, bottoming at just over $1,000 in December 2015. That's a 47% drawdown. 47%. Investors who bought at the top and held through the bottom lost nearly half their capital. But, and this is crucial, those who understood the cycle and bought the bottom made generational wealth because from 2015 to 2025, gold is up over 150% from that low. The people who called it a crash and gave up missed one of the greatest wealth transfers in modern financial history. Or look at 2008. Gold was climbing steadily, hitting $1,000 for the first time ever in March. Then the financial crisis truly detonated. Between March and October 2008, gold dropped 25% as margin calls forced leveraged investors to liquidate everything. People were selling gold to cover losses in real estate and stocks. It looked like the end, except it wasn't. By November 2008, gold bottomed and then went on an absolute tear, rising from $700 to that $1,900 peak in just 33 months, a 170% gain. The investors who panicked and sold at $700 missed the entire move. So when you see an 8% correction and the headlines scream that gold is dead, understand that you're watching a movie that's been played dozens of times before. The question isn't whether corrections happen, it's whether the underlying fundamentals that drove the bull run in the first place are still intact. And that's where things get really interesting, because when you look under the hood, the data tells a story that's far more complex than either the gold bugs or the critics want to admit. Let's talk about what's actually driving this correction right now, because it's not what you think. The first factor is interest rates. When the Federal Reserve holds rates higher for longer, the opportunity cost of holding gold increases. Gold doesn't pay dividends. It doesn't pay interest. It just sits there looking shiny. So when you can get 4.5% risk-free on a treasury bill, some investors rotate out of gold into yielding assets. In January, Federal Reserve Chair Jerome Powell made it crystal clear that rate cuts were not coming as fast as markets hoped. The market had priced in 4 rate cuts for 2025. Powell's tone suggested maybe 2, possibly 1. That repricing hit gold immediately because one of the bull narratives was that falling rates would weaken the dollar and boost gold. If rates stay elevated, that narrative cracks. Second, we've got ETF outflows that are genuinely concerning. The SPDR Gold Shares ETF, ticker GLD, saw outflows of over $3 billion in the first 4 weeks of 2025. $3 billion. That's not mom and pop selling a few shares, that's institutional money heading for the exits. When institutions move, they move in size, and that creates downward pressure that feeds on itself. Algorithms detect the selling, trigger more selling, and suddenly you've got a cascade. The question is whether this is tactical repositioning or a genuine loss of faith in the gold thesis. Third, and this one's subtle but important, we're seeing some stabilization in inflation expectations. The University of Michigan's Consumer Inflation Expectation Survey showed a tick down in January. If people believe inflation is peaking and will moderate, the urgency to own inflation hedges like gold diminishes. Couple that with recent economic data showing resilience in the U.S. economy, and you get a narrative shift from we need protection to maybe things aren't so bad after all. But, and this is a massive but, for every bearish data point, there's a bullish counter-narrative that's equally compelling. And let's start with central banks, because they're not slowing down. The People's Bank of China added another 15 tons of gold to its reserves in January 2025. 15 tons in 1 month? They're not buying because they think gold is going to crash. They're buying because they're systematically reducing dollar dependence. This is a multi-decade strategic shift. When you're the second largest economy on Earth and you're buying gold every single month without fail, that creates a price floor that retail investors can't see but absolutely exists. Then there's the debt situation. And I need you to really absorb this because it's staggering. U.S. national debt just crossed $36 trillion. $36 trillion. That's $120,000 for every single person in America, including children. Annual interest payments on that debt are now exceeding $1 trillion per year. $1 trillion just on interest. That's more than the entire defense budget. When debt reaches these levels, the only way out, historically, has been inflation or default. And governments always choose inflation because it's politically easier. And what thrives in inflationary environments? Hard assets, gold, real estate, commodities. The people who understand this are buying the dip, not running from it. Let's also talk about something the mainstream media completely ignores, the gold to silver ratio. Right now it's sitting around 85 to 1, meaning it takes 85 ounces of silver to buy 1 ounce of gold. Historically, when this ratio gets stretched above 80, it signals that gold is either overbought relative to silver or that a mean reversion is coming. Some analysts argue this correction in gold is actually healthy because it's normalizing the ratio and setting up for the next leg higher in both metals. Silver, by the way, has industrial applications in solar panels, electronics, and electric vehicles that gold doesn't, which gives it a dual investment and industrial demand profile. If gold stabilizes here and silver catches up, we could see explosive moves in both. And we can't ignore the geopolitical powder keg we're sitting on. Tensions between the US and China are escalating. The Middle East remains unstable. Russia's relationship with the West is fractured. Europe is dealing with energy crises and political fragmentation. Every single one of these situations creates uncertainty, and uncertainty drives safe haven demand. Gold isn't just an inflation hedge, it's a chaos hedge, and the world has no shortage of chaos right now. Now let's address the elephant in the room. How does gold stack up against other assets right now? Because if you're deploying capital, you need to know if gold is still the best bet or if something else deserves your attention. Stocks, specifically the S&P 500, are up about 4% year to date as of early February. That's solid, but valuations are stretched. The Shiller PE ratio, which measures price relative to 10-year average earnings, is sitting near 33. Historically, anything above 30 has preceded corrections. Stocks feel expensive, and if we get any economic weakness, they've got further to fall than gold does from current levels. Crypto, well, Bitcoin is doing Bitcoin things, swinging wildly between euphoria and despair. It hit 68,000 in January, pulled back to 59,000, and is bouncing around like a caffeinated kangaroo. Some argue Bitcoin is digital gold, a store of value for the internet age. Others say it's speculative mania with no intrinsic value. The truth is probably somewhere in between, but here's the key difference. Bitcoin is 14 years old. Gold is 5,000 years old. When governments collapse, when currencies fail, when the system truly breaks, I know which one has the longer track record. Real estate is interesting, but illiquid and expensive. Cap rates are compressed. Mortgage rates are still near 7%. Unless you're buying cash or have significant capital, real estate is tough right now. Gold, on the other hand, is liquid. You can buy it, sell it, move it, and it doesn't require a mortgage or property taxes. So where does that leave us? What are the actual scenarios playing out over the next 3 to 12 months? Let me walk you through 3 possibilities. And I want you to think critically about which one aligns with the data and your own risk tolerance. Scenario 1, the worst case. Gold breaks below $2,400 and continues a multi-month correction down toward $2,200 or even $2,100. This happens if the Fed holds rates higher for longer than expected, if inflation truly dies and we enter a disinflationary or deflationary environment, and if the stock market continues rallying, pulling capital away from safe havens. In this scenario, gold investors who bought near the top are underwater for 6 to 18 months, possibly longer. It's painful, it's psychologically brutal, but it's also not unprecedented. This is what happened from 2011 to 2015. If you have a long time horizon, you hold and wait for the next cycle. If you're trading or leveraged, you get destroyed. Scenario 2, the base case. Gold consolidates between $2,400 and $2,600 for the next few months, chopping sideways in a range as bulls and bears fight for control. Central banks keep buying, providing support, but institutional outflows and higher rates cap the upside. Eventually, as we move into the second half of 2025, either rate cuts materialize or geopolitical events flare up, and gold breaks out to new highs, potentially testing $2,900 to $3,000. This is a grinded out scenario where patience wins. You don't get instant gratification, but you also don't get destroyed. For long-term holders, this is actually ideal because it gives you time to dollar cost average and accumulate at reasonable prices. Scenario 3, the bullish case. This correction was a bear trap, a violent shakeout designed to liquidate weak hands before the next explosive leg higher. Gold finds support at $2,500, rebounds hard, and by mid-year, we're breaking $2,800 and pushing toward $3,000 and beyond. This happens if inflation reaccelerates, if a major geopolitical crisis erupts, if a central bank or sovereign wealth fund makes a massive gold purchase announcement, or if the dollar weakens significantly. In this scenario, the people who sold the dip are left chasing, buying back in at higher prices, fueling the rally even further. This is the scenario gold bulls are praying for, and history says it's not impossible. So which scenario is most likely? Here's my take, and understand this is analysis, not financial advice. I think we're somewhere between scenario 2 and 3. The fundamentals supporting gold, debt, central bank buying, geopolitical instability, long-term inflation concerns are too strong for a complete collapse. But the short-term technicals and ETF outflows suggest we need time to digest the parabolic move. I would not be surprised to see gold chop between $2,400 and $2,700 for the next 60 to 90 days before the next major move. The key is to watch the Fed, watch central bank buying data, and watch the dollar index. If the dollar weakens, gold rips. If the dollar strengthens, gold struggles. It's that simple. Here's what you need to understand as an investor. Gold is not a get-rich-quick scheme. It's not going to double in 3 months unless the entire financial system implodes. Gold is insurance. It's the asset you hold because you understand that governments have a long, unbroken track record of debasing currencies, and you want to preserve your purchasing power across decades, not days. If you bought gold at 2,700 and you're down 8%, ask yourself why you bought it in the first place. If it was FOMO, if it was because a YouTuber told you it was going to the moon, then yeah, you might want to reconsider. But if you bought it because you understand monetary history, because you see the debt spiral, because you want protection against the unseen risks lurking in the system, then this correction is noise. It's a test of conviction. The investors who win in gold are the ones who think in decades, not weeks. They're the ones who bought in 2001 at $250 and held through the 2008 crash and the 2011 peak and the 2015 bottom and are now sitting on 10 times returns. They didn't panic. They didn't trade. They understood the thesis and they stuck with it. But let me be clear, you also need to be honest about position sizing. If gold is 100% of your portfolio, you're doing it wrong. If it's 0%, you're also probably doing it wrong unless you have absolute faith that governments will manage debt responsibly, which, let's be honest, is delusional. Most smart allocators keep 5 to 15% in precious metals as a hedge, not as a core growth position. That way, if gold crashes, you're not wiped out. If gold moons, you participate meaningfully. The bottom line is this: gold's correction is violent, it's scary, and it's shaking out everyone who didn't understand what they owned or why they owned it. But corrections are not crashes. Crashes happen when fundamentals break. Corrections happen when price runs too far ahead of fundamentals and needs to reset. Everything I see suggests this is the latter. Central banks are still buying. Debt is still exploding. Geopolitical risks are still elevated. The only thing that changed is sentiment and short-term flows, both of which are notoriously fickle. So is this the end of gold's bull run? I don't think so. I think this is chapter 7 of a 20-chapter book, and the people who close the book now are going to regret it when chapter 20 hits, and gold is trading at $4,000 an ounce, and everyone's asking how they missed it. The opportunity in markets doesn't come from buying what's comfortable and popular. It comes from buying what's hated and undervalued and waiting for the world to catch up to what you already understood. If you found this breakdown valuable, if it gave you clarity in the chaos, do me a favor and smash that like button. Drop a comment below telling me whether you're buying this dip, selling, or holding, and why. And if you haven't subscribed yet, what are you waiting for? We're doing this 3 times a week, cutting through the noise, giving you the data and the context you actually need to make intelligent decisions with your money. I'll see you in the next one where we're breaking down whether the stock market is about to follow gold into correction territory or if we're headed for new all-time highs. Until then, stay sharp, stay informed, and never let fear make your financial decisions for you.